Ford. Ford is one of these stocks that again doesn't show you the volatility on the day chart or on the intraday basis. It's not a stock that I trade on an intraday basis hardly ever. But it is a stock that you can get into and yield over a 4% dividend as they're paying it out right now, and pay yourself a little bit as you hold the stock. And again, the losses tend to not necessarily be as severe when they do happen. We'll pull up the chart on Ford, and this is kind of what I wanted to show you. When you look at a Ford, it's one of those things that again on the week, I have to pull this up to a weekly chart, right? What I showed you on GameStop in my previous segment was a 15-minute chart, and now we're looking at a weekly chart on Ford. But this is a different kind of idea. This is a different kind of play in terms of what are you doing with it, and it's more akin to something that you talked about, like your Chubb analysis in terms of like this is something that your kids can go to college on. This is something not so far out for sure, but you can kind of build out a position and you can manage this very, very easily because it's very, very low volatility today. You see this price action from like the pandemic lows, right? So here's your pandemic low down here at $3. Could you believe that? $3 was your pandemic low, and we did kind of on the weekly.
That's insane.
This is absolutely, people thought that this company was going under, even after the fact that during the 08 market crash, this was the only automaker that didn't take the bailout, right? They said, no, we're good.
That's right.
We'll just go ahead and do our own thing, and they've recovered. Now, do I love their vehicles? They're not my favorite. I won't drive one, but at the same time, I look at this and say, okay, where could we go from here? So we did have this accelerated price action into this $25, $26 level. We kind of cooled off from there. Here is your bottom in and around $11. This is the price of the asset, in my opinion. You look at the price action before that, we've kind of consolidated around there, and we just kind of oscillated in and around this $12 area since about 2010. So this is what I'm saying. I'm showing you guys a weekly chart. So you're sitting in and around these prices pretty much on a consistent basis. You go back, this was the kind of like the 08 crash into 09. We tapped this, we were sub $1. I feel like there might have been some splits or something in here. Maybe it did get priced in and around $1. But I believe that this asset is in and around its average price. Now, with it paying a I think it's higher than 4-point dividend, I like the idea that Ford is going to hold in and around these prices, and that definitively where you're going to be wrong on this stock, right? Sub $11 is probably something you don't necessarily want to be involved with. But if you start to build a position, where do you get out? Well, now you can talk about, this $15 level, this $17 level. And then if it continues to go up, then you do have this. I mean, this resistance to me sticks out pretty heavily. You kind of saw this consolidation on the weekly way back in 2001. We did pierce that price again. I think you get out. If you get up to there, you sell and look to rebuy it lower. But it's something that, as this market feels like it's going to, we're talking about this as as the market is at all-time highs. We're like, well, if the market's going to cool down, where do I kind of pivot to find some stability for my money? Especially if the Fed's going to cut interest rates. Now, some of these other assets that we've been putting our money into, they're not going to pay out as much interest. Where could I start to see some value? Well, now you go back to something like a Ford that pays out a pretty good dividend, and you kind of know where you're wrong. So how do you get into the stock? And that's a very, very good question. So one of the things I like to do on a stock like this, if it's priced a little bit higher than I would like, but I want to be involved in something, again, this is not financial advice. Everybody needs to trade their own book. All right. Then I would look to do something like selling some puts, right? And when you sell a put, all right, that means that you kind of have a bullish bet on it, but you want to buy it at a more favorable price. And so you look at where could you be involved. Okay, so on this platform here, just a quick orientation. we have these are your calls, these are your puts. All right. So we're not going to go through a huge options class here this morning. We don't have enough time for that. But here's what I'll tell you on something. If you like something like a Ford, and you say, I don't want to pay up, here at near 1250 for it, you could look at something like the $12 strike price and sell the put on that. And what does selling a put do? That basically, you get paid out premium, but then you have the responsibility. You get told shares to buy those shares. Now, as long as you have the cash to buy at least 100 shares of the position, you could pay yourself if you bought one contract at a $12 strike price, right? And you're saying as long as it doesn't get to there before June, you could pay yourself $27 for the responsibility if you want to buy in and around that $12 price. If you say, I feel safer at $11.50, you're going to pay yourself $13 for every one contract that you buy, right? And so this is a way to be involved in the stock, pay yourself a little bit for believing in the company because you want to be assigned shares at that strike price. So if you believe in something and it's just a little higher than you would expect it, you could sit there, sell the premium, go ahead and get assigned the shares, and then move on from there. There's a lot of people that trade by selling. They just sell these all the time and then buy it back at a lower price. I just like the idea if you're looking to get into a company and you can't quite get into it, or you don't like the price that it's getting there, you could pay yourself a little bit of money. Now, does $13 sound really sexy? Not really. It doesn't. But at the same time, you could pay yourself $13 and say, I'm buying the stock at 11.50. And if you already know you want to buy the stock at 11.50, then why not pay yourself on the way down? So you can do this, as you go into that expiration date. So this is on the quarterlies. If you say, you know what, I want to buy it at 11.50, but I want to buy it a little earlier, it is a little bit. You're only going to get $3 for it, right? So you can get $3 here, and then you can go to the next weekly and the next weekly and pay yourself. So it's not necessarily a lot of money, but it accumulates over time, and it gives you the opportunity to participate in the stock, get a little bit of money, and then get assigned those shares should you be assigned those shares at that specific strike price. Now, let's go back to why I like the idea of Ford, in terms of a trade that'll pay the dividend, that the risk is easy to manage on. And we'll pull this off to the side here, and we'll go back to the chart. Again, I like the idea of as long as we stay above $11, I like the idea of participating in this, even though I know that I see that we're making lower highs. But this is you got a descending wedge here, and this looks like a flat bottom break. But at the same time, how much money would I have to lose if I got paid a dividend and I got assigned at a strike price? How much money would I have to lose in the share price in order to be at break even or below? So again, taking the $22 into account, right? You do have that buffer there that you've already paid yourself. Now, let me back out of here. If we look at what the dividend paid in the last quarter was, so this is the dividend that they're going to pay out here, effective May the 7th, 2024. So they're going to pay you 15 cents a share on this 4.82 dividend yield, in this quarter. So let's pull out our handy dandy calculator, right? And you say, well, if you hold 100 shares, right, at 15 cents a share, right, you're going to get $15. Okay, so you keep that in mind in $15. So you're going to now, if you look at potential to make, we had $22 if we did the quarterlies in June, and then get into the following quarter, right, in and around that $15 mark. Now you're getting another $15. So you would have to lose at that point, right, somewhere around, my original math was like, if I lost 48 cents on my shares, that's in and around break even. So it allows you to have a lot more room in a stock that doesn't really move that much to start building a position. And if it holds its price, if all it does is stay flat, then you're up 4% anyways, so long as you hold the stock through the ex dividend date and pay yourself out. Now, you do have to look at fundamentals on a company like this. I did show you the technicals. The technicals aren't necessarily the sexiest technicals in the world. If you look at, this is just one website of many. If you look at this, it's getting a rating of they're giving it a medium risk. They're talking about here's the support, and this is more, but this is really more on the intraday for me. um they don't necessarily feel like this is one of those stocks that's going to be like take it through, taking it through the moon. The moon, they're recommending a stop loss if you're in position now of about $11.77, which is about, again, we talk about that 4%, right? Like if you lose 4%, that's your break even point. If you got paid out a dividend, that's in and around that, and so they've calculated this 4.39, just kind of saying, okay, if you held it for this long, and then it's a little bit lower than that 4.87%. But again, it just really depends on how many dividends you've received, so if you can get in and around break even over a 12-month period on a stock like Ford and pay yourself 4%. Now, again, that's leading into the idea that you could possibly gain that 4.87%. So these are the stocks that kind of come back into play when the market's really frothy, and all of a sudden you're kind of trying to rotate out of that and rotate into something else that just has a little bit more stability. And so I'm looking at something like a Ford and saying, this seems to me like this would be a little bit better of a trade, so long as we provide some stability. Again, because I don't currently hold, I haven't gotten into a new position. I already hold a position in Ford at a much lower price, and so it's been paying me already. But if you're looking to initialize a position in Ford, I would wait till that wait till the next earnings date, see what it is that they do on their earnings, see what the reaction is, and then the asset kind of gets repriced after that earnings date in order to provide what to do next. So again, I think in the end, this is kind of like a medium risk trade for me, because it looks like, again, we are in the trend on the weekly. We do have a flat bottom, but what I like about this is that you know exactly where you're wrong. My opinion, you're wrong. You're wrong in and around that 1150 level. So kind of buying it, kind of not. Really going to depend on what it does when it reports next quarter.
Beautiful.